Hello, everybody. Adam Bergman here, tax attorney, founder of IRA Financial. And on today's masterclass, UBIT, Unrelated Business Income Tax. Everything you need to know about this ugly four-letter word. I've talked a lot about UBIT over the last 14 or so years, and it's still a term that not a lot of folks understand. There's a good reason for it because it really shouldn't apply to IRAs or 401ks. And that's why it's always confusing as to, wait, why is this term unrelated business have anything to do with my IRA or 401k? Not a business. We're a retirement account. Our only goal is to grow and provide value to the beneficiaries and owners of the account. Why am I dealing with this tax? Makes no sense. What's going on here? So today's video, I'm going to unpack all the complexities, and I'm going to show you it's really not a very complex set of tax rules. It's actually pretty simple because ultimately UBIT is triggered in only 3 instances. That's it. Okay. Once you're out of those 3 instances, you don't have UBIT. And if you're in those 3 instances, the video will also display some solutions for minimizing and maybe even preventing the application of the UBIT tax. So let's get started. I'm going to keep this 30 to 40 minutes, maybe less. I hope I don't put you guys to sleep. It's an important topic just to kind of issue spot. The good news, if you are a client of IRA Financial, this is the kind of stuff we're going to help you with. So you don't have to navigate these rules on your own. We're going to be here to assist. But as a self-directed investor, the key is issue spotting, knowing what potentially could arise, and then talking to the experts that you work with to help you customize something that works for you. So this is just a little bit about me. You guys probably know who I am. I've written 8 books, and I love what I do. I love the self-directed world. I was a tax lawyer. I have a master's in tax law. And this is the area of focus for me. So hopefully I'm able to shed a little bit of light on this topic, and hopefully I'm going to teach you something. So let's go through UBIT, Unrelated Business Taxable Income. Let's talk about the history. The Unrelated Business Income Tax rules, and you can call it UBIT, UBTI, whatever you want. Okay, it doesn't matter. It matters in the sense that these rules were put in the tax code really in the early 50s. And the history behind it is important because it sheds light on why we're dealing with this today in 2024. I wish we were in 2014. McDonald's. Okay, it's a good example. So what was going on back in the day is Congress, the IRS was worried that companies were just going to set up charities and then run their business through a charity and never pay tax, right? So business A sets up a charity, kind of like ChatGPT, right? Honestly, ChatGPT has taken, or OpenAI, they've taken this approach. They have a tax-exempt foundation for their project, their technology to educate people about AI. And then they did a lot of R&D. They got a lot of donations from Elon Musk and other folks. And they said, hey, we got a good business here. Now let's go set up a business and run the business through another entity. So the government was worried about that. They said, okay, we got to set some rules up so for-profit businesses like McDonald's or GE don't just set up a research and development, educational, tax-exempt entity, do all the activity through there and never pay tax because it's a tax-exempt entity. So they created these rules under section 512, 513, 514 of the Internal Revenue Code that basically says this. And that's why the term unrelated business comes in. And the rules are as follows. If you're a charity and you do anything that's unrelated business to your exempt purpose, they're going to tax you. Okay. So they felt that having those rules in place would prevent businesses like McDonald's or GE from setting up charities, running their business through charities, and escaping tax. So that is the history of the UBTI, UBIT rules. And the intent was to stop companies from moving all their operations into a tax exempt, kind of like OpenAI and ChatGPT. They may have watched one of the videos I've done and said, hey, why can't we do this? They kind of did the reverse. They started as a charity, and then they got people to donate to that charity, get tax deductions for that donation. And then they said, whoa, we actually got a business here now. Now let's go set up a for-profit. So they're able to use pre-tax dollars to start the business. And there'll be 100%, there's probably ongoing IRA scrutiny on it. And I bet $1 million that you'll see some type of IRS crackdown on that type of structure in the future. So as I mentioned, the key word is unrelated business. Okay, now we'll talk about in a few minutes why that term just doesn't really apply to retirement accounts. But for charities like a church or a hospital or a food bank, the word unrelated business makes sense, right? If you're a hospital and you're selling bicycles, or you're selling carpet, or you're selling even parking spaces, or you're selling magazines, is that part of your exempt purpose? Or is that unrelated to your exempt purpose, right? And there's lots and lots of case law about all this. So I will keep it as simple as I can, because for our purposes today, discussing IRAs and 401ks and UBIT, it's not as relevant. But I want to explain to you how these rules work. So if you're a hospital and you probably have been through a hospital, hopefully just visiting, and you've seen there's a gift shop, right? They sell flowers and balloons and magazines and gum and chocolate. And there's also, in some cases, a parking garage where you pay for parking. The way they do it is if they ran those operations themselves, they would pay UBIT tax on the income, because it's unrelated to their exempt purpose, right? Selling Twizzlers, licorice is not really part of saving people's lives. So what do? So they got smart and said, okay, we'll just rent it out, right? We're not going to make money operating these businesses. We're going to collect passive income, rental income from that enterprise. So this way we're not in an unrelated business. We're simply a passive renter of real estate. So any of these institutions, any hospital, they're not operating these gift shops for profit. They're usually, if it is a for-profit enterprise, they're going to outsource it and just collect rent. Now, some hospitals, they'll have like auxiliaries or part of their foundation run it basically at a loss. And that's okay, because you don't have any UBIT tax if there's no profit. But if they're for parking or other types of enterprises where there could be profit, they're going to outsource that to a third party. That third party will pay them rent to use the premise, and then they will get out of the UBIT world. So why does it apply to IRAs? Unfortunately, IRAs are treated as, well, fortunately and unfortunately. The good news for IRAs and 401ks is they're treated as tax-exempt trusts under 501. Okay, so that's good, right? Because one of the advantages of investing through a retirement account is when you generate income and gains, it all flows back to your retirement account without tax, right? That's one of the benefits, the advantages of using a retirement account to make investments. Now, because a retirement account is treated as a tax-exempt trust, it's got to follow suit in any of the rules that apply to tax-exempt trusts. And unfortunately, the unrelated business taxable income rules apply to 501 trusts. Now, what they should have done when IRAs and 401ks were created in 1974 is exempt them from the application of UBIT. It never happened. I wasn't born then, so I can't even take responsibility. Couldn't have stopped it. I've had numerous conversations with a number of members of Congress in the Ways and Means Committee, members of the Senate Finance Committee, both Democrats and Republicans, and they all are shocked and surprised at these rules. They don't understand them. They never heard of them. At the same time, it actually generates tax revenue for the government, because if there is a UBIT tax, we'll see in a few minutes, there's a tax to pay, and that tax revenue will go to Treasury, which will then use it for government purposes. So it's going to be very hard to kind of turn that faucet off, especially when Biden administration is looking to upgrade certain social policies. They're going to need more tax revenue. So I don't see any way on earth they're just going to eliminate a tax that is bringing in some type of revenue. So that is why UBIT applies to retirement accounts. It's only because it's treated as a tax-exempt trust. So that's why I'm sitting here right here, and that's why tens of thousands of investors have to know how these rules work. Let's move on. Okay, so this is very, very important. Almost all retirement account income investments do not generate UBIT, okay? Almost all. I'd say 95% of retirement IRA or 401k income and gains do not trigger UBIT. That's great. Why? Because the 5 categories of passive income are not subject to UBIT. What are they? Pretty important, right? Capital gains, interest, dividends, royalties, and rental income are not subject to UBIT. So let's go through them. Capital gains. You buy and sell Apple stock. Buy and sell Bitcoin. Not subject to UBIT. You get interest on a loan. Not subject to UBIT. You get dividends from a company. Not subject to UBIT. You get royalties from a patent or a copyright. Not subject to UBIT. You get rental income from a property. Not subject to UBIT in general. I hate using the word in general, but you're going to see in a minute what I mean. So for most of you watching, the UBIT tax should not be a problem. It just shouldn't, because if you're buying and selling stock, buying and selling cryptos, buying and selling gold, buying and selling real estate, so long as we'll see there's no leverage, buying and selling any asset without leverage, no UBIT. Interest from loans, no UBIT. Interest from credit funds, no UBIT. Dividends from companies, no UBIT. Royalties from patents, no UBIT. Rental income, as long as there's no leverage, which is hard to do in some real estate deals, no subject to UBIT. Okay, so just remember that. The 5 categories of passive income are not subject to UBIT. Why? Because they're not unrelated business, right? Remember, what are we talking about here? Unrelated business income tax. So if you have a passive category of income, like capital gains, dividends, interest, royalties, rental income, that's not business income. Now, could a passive activity rise to a level of business? Yeah. But for 99.9% of investors in the IRA and 401k world, it's not the case. You're not going to treat yourself as a trader of securities, right? You're not, even if you're selling stock 50 times a day, it's still passive. It's your retirement account. If you flip 20 homes a year, yeah, could the IRS see you as a business? Sure. I don't know many people are flipping 20 homes a year. If you flip 2, 5, 6, 7 homes a year, you're probably not a business, right? Again, it's in your IRA. There are a number of categories the IRS will look at to whether an activity is passive and active, right? Your frequency, your intent, duration between hold and sell, and what you do personally. Those are all the factors the IRS would look at, but it would take a lot to turn a passive activity active. Okay, this is the most important slide. I'm going to back away for a second here. This is the most important slide of the presentation. This is it. There's only 3 ways to trigger UBIT. That's it. 3. That's it. First one's not really relevant to most folks, right? You use an IRA or 401k to buy margin to trade stock, or use a loan to buy an asset like equipment. Now, again, we know the loan has to be non-recourse, right? If you watch last week's video on prohibited transactions, you know that you can't personally guarantee an obligation of your IRA. So the loan must be non-recourse. But most folks aren't buying margin in their IRA or using margin in their IRA. One exception, if you do option trading, foreign currency, option trading is not considered margin. So if you short stocks or you do calls or puts, that is not margin. Margin is like, hey, I'm borrowing money and using my brokerage account as collateral to buy more securities or more assets. Option trading, where you're borrowing a stock to short it or go long on it, is not deemed margin. That does not trigger UBIT. So the first is not that relevant because on 14 years and doing this stuff, there's not many people that will trigger one. The next two are the keys. Okay, let's start at two. If an IRA or 401k invests in an active business, like a restaurant, you know what an active business is, right? Consulting company, a manufacturing company, software company, a retail operation, a store, a restaurant, a bar. I don't know. You know what a business is, right? And the business is operated through a pass-through entity. Okay, that's the key. What's a pass-through entity? It's basically an LLC, an S-corp, although IRAs can't invest in S-corps, but let's assume they could do. It's an LLC or partnership. Okay, a C-corp is not deemed a passive entity. Think of it as a C-corp as a big box, right? Corporations have two layers of tax: corporate layer, individual layer, two tax. So the UBIT tax does not have to apply to a C-corp. It doesn't have to. It doesn't, because there's already a corporate tax. There's no need for the UBIT to jump on top of that and tax the unrelated business because the corporation is already subject to corporate tax, which is now 21% in 2024. But pass-through entities like LLCs or partnerships are not subject to corporate tax, right? They're flow-throughs. The owners are subject to the tax, not the entity. So in that case, if your IRA owns an interest in a restaurant and the restaurant's through an LLC, because there's no entity level tax at the LLC level and there's more than $1,000 in net income, the UBIT tax will get triggered. Okay, so that's important. Now, if you're buying stocks, mutual funds, ETFs, they're almost all corporations. Even REITs are pass-through, but they're not subject to UBIT, still considered corporate. You're not dealing with UBIT. Okay, that's why for most Americans, the UBIT tax just doesn't apply to their IRA or 401k investment. Just not relevant. But if you're doing alternative assets with an IRA or 401k, number two could hit you, right? I'm investing in my buddy's business. I got to ask the first question: is it a LLC or corp? How do you know? Well, if you see the words Inc. at the end or corporation, it's probably a C corp. You're good to go. If you see the word LLC at the end or LP, partnership, now you got to start asking questions. And this is what I'm talking about, issue spotting. Okay, you don't have to know the answers, but you want to issue spot because the UBIT tax, which can go as high as 37%, could turn a really, really great tax efficient business into an inefficient investment. And I'll be honest, there's many times a week where I tell folks, hey, don't do this in your IRA. Don't. The UBIT tax is going to kill you. It's better to get 15% capital gains. Personally, 37% is not worth the deal. And I'll give you my honest opinion. Some will say, well, I need to do the deal. I don't have enough money elsewhere. And I don't care. And others will say, okay, I appreciate it. I'm moving on. So issue spotting is key. That's why educate yourself. Education's power, right? That's how you become a better investor. Whether you're a client of IRA Financial or not, you still want to be able to issue spot. You know, if you're our client, we're going to help you do this, so you don't have to worry. But even if you're not, my job is to help educate you guys. So number two. Now, what about if you invest in a private equity fund? What does a private equity fund do? Well, invest in companies. Now, you have to ask the private equity fund, and they'll tell you because there's in their subscription docs and private placement, they're going to mention UBIT. Now, some private equity firms that have a lot of pension plans as investors will only invest in companies that are C corps because of UBIT. They don't want to get triggered UBIT. Like if CalPERS invest in a private equity fund, they're only investing in companies that are corps. I promise you. Now, let's say you invest in a private equity firm and they're going to invest in portfolio companies that are pass-through. You got to ask that question. Hey, who's going to calculate UBIT? Oh, well, how do you even know if there's UBIT? Well, as a limited partner in a partnership or a multiple member LLC, you're going to get a K1. Okay. And the K1 is going to identify whether there's UBIT. It has to. If it's not on the K1, the only way to see it is if it's business income. But in a private equity firm, you're not going to see business income. They will actually include on the box with a code UBIT, the UBIT number, and you'll see it on the K1. But if you're investing in a small deal, your friend's business, you'll get a K1 if it's an LLC or partnership. And then if on line 1 where it says business income, then you'll know if UBIT's triggered. Now, if there's not more than $1,000 of income attributable to your retirement account, there will be no UBIT. So that's why number 2 could pop up, whether you're doing a direct investment into your neighbor's restaurant, or if you're investing in a private equity fund or venture capital fund that invests in businesses. You then have to ask the question, how are those businesses structured? LLCs or corps? Corps, you're good to go. LLCs, you need to start thinking about UBIT. And then the third one, use a non-recourse loan. Remember, I use the word non-recourse because you can't personally guarantee a loan with your IRA or 401k. So the loan always has to be non-recourse. And use a non-recourse loan to acquire or purchase real estate. Now, I'm going to talk about the exemption in a later slide. There is an exemption for 401k plans. So this number 3 does not apply to 401ks. 401ks only have to deal with 1 and 2. If you have an IRA has to deal with 1, 2, and 3. So what does that mean? I have 100K in my IRA. I borrow 100K non-recourse. And now I have 200K, and I use it to go buy a house, and I rent it out. I generate $10,000 of net income after deductions, depreciation, expenses. What do? Well, 10,000 is more than 1,000. Okay, but you get to allocate how much of that net profit, that 10,000 bucks, is actually debt financed. Well, in the example, I used $50,000 debt, $100,000 debt, 50%, and $100,000 equity, 50%. So in my example, 10,000. 50% of the 10,000 or 5,000 bucks would be subject to the UBIT tax regime. Okay, so this is super critical to understand, because imagine you put down, I don't know, 100 grand from your IRA or 401k, and you invest and you borrow 900K. Now you have a 10 to 90 ratio. So if you're in an IRA, 90% of the net profits could be subject to UBIT. In a 401k, you don't care, right? You're just living life and you're happy. How do you get into a solo K? Well, next week, or 2 weeks actually, I'm going to take a break next week. I have my kids' spring break, so I'm going to be with them. But we're going to do a video on the solo K and multiple videos following that on solo Ks. But to set up a solo K, you need to have a business, sole proprietor, single member LLC, C Corp, S Corp. And the business can have no full-time employees other than the owners or their spouses. Full-time employee means 1,000 hours or 3 consecutive years of 500 hours or more. So it could be drive for Uber, it could be a consulting gig. It doesn't have to be a $1 billion business. It just could be a side gig. And then you could set up the solo K, roll over money in the solo K, acquire real estate with leverage, not pay UBIT. So that's why the solo K, I keep saying, I've done so many videos and podcasts and blogs on it, is the ultimate retirement plan for real estate investors. Because you can leverage up your plan and you don't have to deal with UBIT, which is every real estate investor's dream, right? Other people's money, no tax. Doesn't get better than that. Nothing is better than that. So those are the 3 things. I'm going to keep this up for a bit and come back to it because it's really important to remember it. So again, just to summarize, passive categories of income like interest, dividends, royalties, rental income, capital gains, not subject to UBIT. Only 3 ways to trigger UBIT. Use margin to buy stock or a non-recourse loan to buy an asset. Use a non-recourse loan to buy real estate. Exception for 401ks. UBIT is not triggered for a 401k. It is for an IRA. And then your IRA or 401k invests in a pass-through business and generates more than $1,000 in net income. So number 3 gets triggered. Let's say you want to invest in a real estate fund or a hedge fund, and you're going to use leverage. The hedge fund probably has to deal with this. You invest in a hedge fund and uses leverage to buy stock or do investment strategies, UBIT could get triggered. You invest in a real estate fund, pass through, and the fund uses leverage, even if it's recourse and it's not personally guaranteed by you, could trigger UBIT. Okay, this is why it's so important to issue spot. Okay, I wanted to talk about UBIT versus UDFI. A lot of people get confused with the terms. UBIT, unrelated business income tax, UDFI, unrelated debt finance income. Same thing. It triggers this triggers this. So you can call this UBIT. It doesn't matter. Some people are like, well, UDFI. I'm like, it's section 514. It's the same thing. If you trigger UDFI, you trigger UBIT tax. Doesn't matter. But I just want it to be clear. Okay. UDFI section 514 of the tax code. It relates to real estate acquisition indebtedness. Using a loan, leverage to acquire or buy a piece of real estate. Okay. If you do it in an IRA, a percentage of your net income or gains, whatever relates to the use of the debt, would be subject to UBIT. Whereas if you use the 401k plan, you would get out of the UBIT tax regime. Why does this exception apply? Why doesn't it apply only to IRAs or also to IRAs? So 1980s when the exception came in the tax code. This is the reason why. According to legislative history, it just comes down to Congress wanted pension plans like CalPERS to have more investment options. And they understood the amount, an enormous amount of money these pension plans have. And they wanted to help them supplement the U.S. real estate market. And it's a great thing. The problem is they didn't realize that the IRA marketplace was going to grow as quick. In the 1970s and 80s, the IRA contribution amount was tiny. And I don't think they understood the rollover regime. So this exception should apply to IRAs as well. It doesn't make sense why it's only 401ks. There's $33 trillion of retirement money. There's $13 trillion of IRA money. The IRA should have the same exemption of 401ks. It doesn't. Again, put me in Congress and I'll make it happen, guys. But this is another reason, and this is why I focused on before, is why the Solo K is such an amazing investment and retirement vehicle for the real estate investors. The Solo K, you can buy real estate, you can use leverage to not pay UBIT tax. You can also put away $69,000 or $76,500 pre-tax or Roth. You can borrow up to $50,000. There's so much you can do in a Solo K. But for real estate investors, the use of leverage is so important that I think it kind of trumps everything else. Okay. So here's the tax rate. These are the trust tax rates. The UBTI tax follows the trust tax rate. If you have under $1,000, there's no tax. Okay. That's important to know. Losses. Most startups, real estate projects in the first few years have losses. And the good news is you can take advantage of those losses and carry them forward to offset any future income from UBIT. Okay. So that's important. Now you report UBIT on Form 990T, which I'll talk to in a minute. It's due April 15th. Now, this is super important. IRA Financial is one of the few companies in the country that files a 990T for our clients. Okay, we don't force you to use a different accounting form. We have a built-in accounting solution in-house that will allow us to file the 990T. You obviously got to work with us and tell us. We're not magicians. We're not prophets. We don't know what you have. But if you work with us and engage us, we will do it. If you're part of our annual compliance fee, which is just $299 a year, if you're an IRA client or $399 Solo K, it's included. No extra fee. Very important. I think it's a very, very critical aspect to why IRA Financial is, I think, so successful. Is we don't just set up accounts like 401ks or IRAs. We go well above and beyond. And UBIT's a perfect example. Why? Because we'll help customize structures in ways to minimize UBIT or eliminate it. We'll file any UBIT tax, we'll report it, we'll record keep it, and we'll keep you in IRS compliance. I don't think anyone else in the country that does it. So yeah, I get hurt when I hear folks say, yeah, I used another company, Adam. I respect everyone's decision, but personally it hurts me because I really, truly believe IRA Financial is the best. Again, every custodian is going to do the same, like 5498, 1099R, like that's easy. Software does it. That's such a small fraction of what we do. It's everything else. So I talk to our billing department a lot, and I'd say probably like 85, 90% of our clients pay this annual compliance fee. But there's always a few that like fight it. And I'm just like, I don't get it. Like it's a few $100. Go find a lawyer and accountant that's going to file your 990T, file a partnership return, answer all these questions for $299. Like, we're not making money on this stuff. Like, we're just trying to allow ourselves to hire the right people to give you the advice. And then people are like, no, I don't want to pay it. And then they call us 6 months or a year later and they expect an answer. And we're like, dude, you think we're a charity? Like, come on, you disrespect us. You don't want to pay $200. And now you want us to analyze your solution and give you an answer for free? I don't know. It just always rubs me the wrong way. Like, we keep the annual fees low on purpose because we have so many clients and it allows us to go out and hire the best people. But I mean, it's a couple $100. And listen, if you can't afford $299, okay, let me know. We'll make a deal. But don't just say, well, I can't afford it, I'm not doing it. But I still expect this type of service. I don't know. It's just not right. So here are all the trust rates. You can see if you are a 1040 taxpayer, the highest tax rate of 37%, or it's 30, is triggered at like $650,000, right? Personally. Here, it's triggered at $14,451. So that means if you do an investment, let's say use leverage to buy real estate or invest in an active business and you generate more than $14,451 of UBIT, you can pay tax of up to 37%. That's crazy. That's high. Individual tax rates. That's not good. No bueno. So that's when we're going to talk about strategies to eliminate and reduce it. File the 990T. It's due April 15th. You can get an extension. Okay, here it is. This is a fun slide. Okay, I'm just going to get a little caffeine and keep me going. The easiest way to reduce the application of UBIT is to put a C Corp there. Remember, C Corps block UBIT, but C Corps do have a 21% tax rate. So I wrote limiting here. I didn't write eliminate. There is ways to eliminate. We'll talk about that at the bottom, but I can limit your UBIT by putting a blocker. So let's say you had an IRA that invested in your buddy's restaurant, and the restaurant's through an LLC, and you put in $100K, and the restaurant's going to get bought by, I don't know, Panera is going to buy it for $50 million. Okay. If you sell the interest, that's capital gain, that's fine. But if it was an asset sale, your IRA would pay UBIT tax, assuming you'd have more than $14,451 in gain on the gains. But if I put a C Corp blocker in there, you could eliminate the 37% and reduce it to 21%. Now, yes, you'd pay 21% across the board, but that's less than 37%. Still better. Now, for real estate investors, let's say you use non-recourse loan, right? This is where you got to do the math, and this is where you got to work with us. So let's say you put in $100K and you borrow $100K, 50-50 debt to equity ratio. And let's say simply, for example purposes, you have $10,000 in net income after depreciation and the like. Now, if we did a blocker, I can get you at 21%, so $2,100. Now, if we did the UBIT tax and just remove the blocker, remember, 50% of the 10,000 will be subject to UBIT. That's $5,000. The tax rate on $5,000 is 24%. So you're better off doing the UBIT blocker. But let's say the tax was, let's say it was only $1,500 of UBIT, and that's $1,500 in net income. The tax, UBIT tax, only 10%. So you got to kind of assume, estimate, guesstimate where you'll be. But I assume if you're doing an investment, you are expecting more than $2,900 of gains annually. At least I would assume that. So that's why the C Corp blocker generally works out. Now, if you only got 5% of leverage, then the UBIT application would be a lot smaller because it would only be 5% of your gains. So if you had an $80,000 gain, it would only be 5%, which maybe would bring the UBIT tax below the 24%. But this is the most popular way to limit UBIT blocker. Now, there are also ways to do form blockers. I think we're probably one of the only companies that actually understand this stuff. Again, another reason why IRA Financial is the best. I actually have competitors of my colleague asking how this stuff works. But a form blocker will work in certain instances. Generally, in real estate, foreign blockers don't work because of something called FIRPTA. Foreign blockers could work in private equity for generating capital gains, venture capital, potentially capital gains, and some hedge funds, depending on how the income, if you're getting, depending on interest income, yes, dividend income, maybe, and capital gains income, yes. So that is a potential application, and we can work with you. We've done a lot of investments for clients at the Cayman and other foreign jurisdictions like Mauritius to use a foreign blocker to reduce tax. And again, I don't think anyone else in the country has our expertise in this. And then if you want to eliminate UBIT, the easiest way to do it is to restructure your equity investment as a loan. So let's say you're investing in a private business and you're going to buy 10%, and the business is an LLC. More than $1,000 in net income, you're going to trigger UBIT. But instead of investing, if you lent the company money, it's a loan. So as I mentioned, interest is not subject to UBIT. So you'd be able to escape UBIT. Now, I guess the downside of doing that would be the downside is that you have no equity. So all you have is a guaranteed rate of return. So let's say it's a 10% note on 100K, you're getting 10 grand, let's say over 10 years plus interest. Whereas if you've invested in ChatGPT and it's now worth $1 billion or 30 trillion, whatever the hell it's worth, your upside's much greater, riskier, loan's more secure, but upside is greater with equity. You can do a convertible note, but remember, once you convert it, you're going to have UBIT potentially if it's an LLC. So this is always like my go-to, a C-Corp blocker. Foreign blocker could come in, but it's way more complex. And the loan to equity for some of my investors just doesn't work because a lot of investors want the upside. So something to keep in mind. Now, I got some other solutions that I keep in my back pocket that I kind of use for me. So I mentioned this and talked about this, and I'll get to some questions in a few minutes. Just going to finish up the presentation in the next 3 minutes. I talked about how it's triggered. You need at least $1,000. It's a pro rata share of your acquisition indebtedness. It reduced by deductions. You get loss carryover, so we'll follow the 990T to lock in the loss, which can offset future gains, and it's in a 990T. I said, what investments trigger UBIT? The most important, use leverage to buy an asset, a non-recourse loan to buy real estate, invest in a pass-through business. Now, when I say it's got to be a business, if you invest in an LLC that's doing passive income, like Bitcoin, stocks, just flipping real estate without leverage. The key with this is it could be a pass-through, just can't trigger business income. So if you're investing in a pass-through for passive income like capital gains, interest, dividends, royalties, rental income, no UBIT. If you're investing in a pass-through that is a business, you're going to have UBIT above $1,000. Okay. The loan to real estate, remember, exception for 401ks. I talked about this, tax consequences, and the IRA Financial. The one thing I want to talk about, which I didn't see, I don't know. Okay, so on UDFI, I want to go back to this. The way you calculate UDFI is, again, you need leverage and you need real estate. So you don't have UBIT without real estate and the acquisition indebtedness, right? If you pay all cash for real estate in an IRA 401k, you're not going to have UBIT, assuming it's not a business. So you need the leverage and need real estate acquisition indebtedness. Now there's also some complex rules about how it all works, but this is the most important part. Is the UBIT is basically triggered based off a percentage of the acquisition indebtedness. 401k is exempted. In order to get that exemption, generally, you obviously need to have the 401k, and it's got to be real estate acquisition indebtedness. In one case, if only the 401k is a partner in the fund or the structure, it's okay. And if there are other non-retirement pension plans, it's okay as well, as long as allocations are pro rata and there's no monkey business where the 401k is getting a greater share of the allocation than the non-401k. I just wanted to mention that. I'm going to get to the questions in a minute, I promise. I'm going to just leave the last page up. You guys just know it's everything I said, why IRA Financial is the best, and why I get so hurt when some investors don't use us because we go above and beyond. It's just the truth. And like I said, I'll debate anyone in the country on this stuff. I'll put my team up against anyone in the country. And we're not just going to charge you for the admin. We're also going to do a lot more, like consult, and we're going to do all the tax reporting and filing. That's so important. Okay, let's do some questions. Let's have some fun. John, what if an LLC develops a product with patents, then sells the patents and all rights to produce the product without ever producing or selling the product themselves? So I think you're good. I mean, I have to understand what developing means. If it's a business, then if the LLC just sells the asset, if it's a business asset, you could have UBIT. If it sells the interest in the LLC, you could be okay. You could be exempt because that could be a capital gains transaction. So I need to understand the patent's a capital asset. Is it a business? If it's a passive royalty from patents, you're okay. If the business is selling the patents and you're selling the asset, that could trigger UBIT. But if you sell the LLC interest, you could circumvent the UBIT tax. Let me just go to the first screen so everyone remembers what the topic is for today's video. Okay. Could I roll over my self-directed checkbook control over to a 401k if I have a small business? Yeah. So long as you have no full-time employees other than yourself or your spouse or other owners, you're good to go, Chris. And you can set up a solo K. And if you're a real estate investor, bank, use non-recourse loan without triggering UBIT. What are some of the best practices to minimize the possibility of purchase contract assignment, wholesaling becoming subject to UBIT? I'm not worried about that, house help. It's so passive. I don't see how the IRS could argue flipping contracts is going to be a business. Again, they're going to look at a number of factors, your intent, your frequency, what you do personally, the timing in between the transactions. But it's like stocks, right? In order for the IRS to argue that buying and selling stocks is a business, you literally have to treat yourself as a business. And because this is an IRA or 401k, I'm not worried, house help. You're not going to be a business. Even if you do 500 a year, it's not a business. It's so passive in nature. What's the minimum advised amount? So again, I don't see the IRS ever arguing that's a business. I have some competitors that say, well, if you go above 4 or 5, they don't know what they're talking about, just because flipping contracts is a lot different than buying and building a home. Yes, if you buy a tract of land and build 15 homes and sell it, you're a business. Yeah, you got to build the homes. I'm sure you have employees, you have contractors. You're a business. Flipping contracts, you're not a business. It's passive. So I have no concern about numbers either. Can a blocker entity be an LLC taxed as a corp? It's a great question. I would rather you be a C corp. Some people take the position that's possible. I am more conservative. I just feel better having a C corp because there's no issue. There's no question. So I would rather you be a C corp. It's a great question. Can a loan have a profit sharing component? No, see, it's a great question. So the IRS actually has, there's case law and the IRS actually has elements to show what is debt, what is equity. So in your head, you can call something debt, but if it's not a real stated rate of return and it's up to the future profits of an enterprise, you may call it a loan. The IRS is going to call, you might call it equity. The IRS is going to call it a loan. You may call it a loan. It may be equity. It's what it is. The facts determine it. So if you call your document a loan, but you're getting a return based off the profits of the enterprise, that's equity. The IRS is not going to care what you call the document. So a loan's a loan, right? I give you $100 and you pay me 5% interest, 10% interest, and I get my $100 back. That's a loan. If I give you $100 and you say, okay, Adam, you get 20% of the profits of my business, looks a lot more like equity. Now you could play around with the interest rates, right? Maybe you charge yourself 15, 18% to try to get yourself to an equity level you're comfortable with, but you really want to make sure it's debt, not equity. What is the highest points and rate I can lend myself with a straight face? So you got to look, every state has loan shark, rules in terms of highest interest rates. There are exceptions. Obviously, we know credit card companies and commercial loans charge above those rates. Listen, the prime rate's 8.5%. So going to 18, 20% is probably reasonable. 100%, probably not. But it also depends what state you're in. What filing, if any, starts the statute of limitation for UBIT? No filing. Technically, it's when you do the transaction. Now, the IRS may argue it gets the 990T starts the UBIT 3-year statute, because if you don't file the 990T, the IRS isn't on record. But you would take the position that the UBIT gets triggered when I did the UBIT transaction, not when I file the return. And I think that's the position. So generally, the IRS would have 3 years to catch you even if you haven't filed the 990T, you would argue the UBIT occurred when it occurred. They would probably take the position it's when you file the return. But you would then say, well, I didn't know UBIT existed. I'm taking the position UBIT didn't exist, so why would I have to file? So I think you would have the stronger argument. It's 3 years from when you do the investment. Are there any state taxes related to UBIT? So no, it's a federal tax, and most states will follow the federal tax treatment. So no. If solo 401k makes an investment in real estate syndication where leverage is involved, is there any situation that would trigger UBIT? Yeah, Brian, 100%. Great question. Let's do this. So you invest in an investment fund, okay, 1,000 people, $500 million fund. All real estate funds are LLCs or partnerships. So that syndicate is a pass-through. Now, syndicate has the 500 million, and then it goes develops real estate, commercial, residential, builds, whatever. Brian, those activities are generally done through pass-through. They rarely have a C Corp blocker. Now, it could happen, right? It could happen where the syndicate decides to have a corporation for whatever purpose. But almost all cases, a real estate syndication will be a passive enterprise, meaning there's flow-throughs up and down. There's no corps. Why? They want the losses to flow through. They don't want to shelter the losses in a corp. They want all this to flow through the investor and investors. Same time, the income and gains flow through. Now, in a lot of those syndications, the losses will offset a lot of the income up front. So in some of those syndications, they're going to disclose UBIT issues. Now, if there were pension plans investing, they would potentially have the pension plans go through a C Corp blocker or maybe a foreign blocker, but probably not if it's real estate because you'd have FERPTA. So, Brian, you hit the nail on the head. I mean, this is an issue a lot of people don't realize is you invest in IRA in a syndicate and you could have UBIT. Now, if a solo K invests in a syndicate, generally you're okay, right? You have a 401k, you have real estate acquisition indebtedness. Even if there's other partners under 514, as long as the allocations are pro rata and reasonable and are allocated to the proper partners, even if they're non-IRAs in the syndicate, you should be exempted from UBIT under 514 because it's an or, it's not an and. It's not that all partners have to be pension plans and there has to be proper allocations, it's or. So as long as you get one of those, you're going to be okay. So yes, the 401k in that case, Brian, will exempt UBIT. That's why they put that in. If CalPERS in 1980, when they put the exemption to 514C9 in there, allowing CalPERS and other pension plans that are 401ks to invest in a 401k syndication without triggering UBIT, they obviously knew CalPERS is not going to be the only investor, right? There's other investors. So that's why as long as the allocations are proper and the pension plan's getting proper allocations based off investment allocation, they'll be able to avail themselves of the exception under 514C9. Okay. Robert, I have an accumulated cash in my self-directed IRA LLC. If I buy a treasury bond, I will get a 1099 at the end of the year. If I have losses through the real estate partnership, do I need to file? No. If you do not have any income, you don't have to file. Okay. There's no UBIT if there's less than $1,000 net income. Now, that being said, I have a lot of clients that will still want us to file the 990T to lock in the losses so they can use them to carry forward. So in that case, you technically don't have to file a tax return, right? The 990T technically is not due because there's no income, but some folks like to file the 990T anyways to lock in the losses. Now, others would say, well, I don't need the 990T to lock in the losses. I have the losses. I have a record of them. The return and instructions are clear. If you have less than $1,000, you don't need to file the 990T. But if you want to be super careful, Robert, we can file the 990T for you so you just have a record of those losses. Who should I contact at IRA Financial to consult with some of these strategies? So, Chris, you can email info. You can go on our website and just set up a Calendly. Okay, you can say get started, and there's 3 options. There's a Calendly, a quick get started if you just want to set up an account in 2 seconds, or you can just download our app and go through a more formal process. But Chris, go on our app, set up an appointment. It's free, and we'd love to chat with you. Next question. What about investing in commercial real estate through CrowdStreet that invests in apartments or hotel? Would that trigger UBIT? Rand, in a lot of cases, yeah. Again, if that enterprise, assuming it is a pass-through like a limited partner, LLC, limited partnership, there probably is UBIT. And you should ask those questions, okay? This is why we're agnostic. We don't sell products. All I care about is my clients. I get a flat fee, whether you invest in CrowdStreet or do your own investment. I don't care. I don't charge you more for multiple investments. If you open an account with IRA Financial, you can have 50 assets in that IRA. Charge you one account fee. So I'm giving you the right answer. I have a volume business. I want to keep you happy because you're going to come back and you're going to tell your friends and family and they're going to open accounts with me. So a lot of times, Rand, I'll have clients that say, hey, I'm doing this investment in this real estate syndicate. I have an IRA. I don't have a 401k. Because the first question I'm going to say is get a 401k. They're like, I'm not self-employed. I'm retired, whatever. I say, okay. You need to ask them, you're going to be UBIT. They got to tell you. You're going to look at the disclosures, do an edit find in their PPP or subscription docs. If they don't disclose, you need to ask them. Will these real estate investments be done through a pass-through with leverage? 100% yes. No real estate deal I've ever heard of has no leverage. Even Jeff Bezos or Elon Musk will use a loan to do real estate. It's stupid not to, right? You got to use other people's money. No one's going to use all their cash. So you just buy more. It's smart. Take advantage of the advantages of leverage. So in a real estate syndicate with an IRA, when you have more than $1,000 in net income, you're going to have UBIT. And I'm telling you, not a lot of people are going to tell you this. I'm telling you the truth. I'm telling you the truth. Okay? That's what's going on. So I want to get you in a 401k. If I can't, I can try to minimize it with a C Corp blocker, which you may say, that's cool, 21%. It's not 15, it's not 0, but it's better than 37. Let's do a C Corp blocker. They may have a foreign blocker, but probably not for real estate because of something called FIRPTA, which is a withholding tax on foreign-owned real estate. So Rand asked the question. Ask us. We'll help you. But very, very, very important question. Should I file 990T with 0 owed to lock in statute of limitations? You could. House help. You could, and we can help you do that. Please poke holes in the strategy. Okay. My solo 401k starts a blocker corp of wholesale and real estate. All profits used to fund marketing and grow business, so no operating profit. Sometimes in the future, the 401k sells the shares in a corp for big capital K and finances sale at cringeworthy but legitimate terms. Have I avoided corp tax? Well, you never avoid corp tax, right? Because if there's corporate tax, there's corporate tax. Now, if you can offset the income with expenses, then good for you. Now, if you can sell the stock, you want to own it in a Roth 401k, house help. But if you can get someone to buy it at a big, big number, then yes, you are Peter Thiel. You are a brilliant investor with a retirement account, and you beat the system. You didn't do anything illegal, so long as you're not selling it to a lineal descendant or yourself or any family member. But yeah, there's nothing wrong with starting not a business, right? So let's say your 401k owns 100% of this corporation. You can't do any of the work yourself. So let's say you hire John Doe or Jane Doe to do all the work. You pay them, you zero out, so there's no corporate tax. Then you get company Y, come and buy your business for $50 million. Yeah, capital gains, no capital gains tax-free to Roth 401k. I have a lot of strategies like that. But you need to make it work. How do you make it work? You need the right facts, right? You need to have a startup. You got to invest at a low price. You got to have a good business. And even if you pay corporate tax, who cares, right? The key is to shelter the gains from tax, that capital gains. So then obviously you got to find a buyer that's willing to buy your business for a lot of money. So yeah, I have a lot of strategies and sort of my team. There's no capital gains when your 401k sells it. There's no capital gains to retirement accounts. There's a corporate tax. Then a corporation can actually dividend the retained earnings to the 401k tax-free as well. So you can't get around the corporate tax, even under ROBs. You can't get around the corporate tax. You can try to minimize it with expenses. But whatever you pay, 21%, then you can dividend back to the 401k tax-free, or you can sell the stock from the 401k to someone else tax-free. LLCs, you got UBIT. Block it with a C Corp. Best book for advanced strategies, I think my book, right? Solo 401k in a nutshell, Self-Directed IRA in a nutshell. I'm actually writing a book right now on this type of situation, advanced strategies for self-directed investors, which I hopefully will release in the coming months. Who's the best value tax attorney, CPA? Reach out to us. We'll let you know. But we can help you with all this stuff. If you're a client house help, we got in-house capabilities. You don't have to spend more. Can a Roth IRA with real estate investment trigger UBIT? Yeah, the UBIT rules apply. It's a great question, Chris. If you have an IRA, a Roth, a SEP, simple, 401k, 403b, defined benefit plan, UBIT applies because, again, you have a retirement account that's a 501 trust. So, yes, but again, there's ways to minimize it, blockers, debt versus equity, and other solutions that potentially could work. But remember, last thing I'm going to say, I'm going to wrap up in 2 minutes. In most cases, there's no UBIT tax. Capital gains, interest, dividends, royalties, rental income, no UBIT tax. UBIT's triggered 3 ways for an IRA. 1, use leverage to buy an asset, like margin to buy stock. Invest in an active trade or business through an LLC or partnership. Or for an IRA, use acquisition indebtedness, non-recourse loan to buy real estate. You need to have more than $1,000 in net income. Then you file a 990T. The IRA or your 401k pays UBIT. You do not pay the UBIT tax. This is an IRA tax. You'll get a tax ID number for your IRA. We'll do it for you. And the IRA will pay the UBIT and file the return in the name of the IRA, not in your name. This does not go with your 1040. Okay, it goes with your IRA. So this is not a scary tax, but as it was brought out in all these amazing questions, Rand, Chris, Robert, Brian, real estate syndications trigger UBIT in a lot of cases. Now, you can use the losses to offset future. This is where a C-Corp blocker comes into play. And this is where potential other strategies also could work. But take this away. Don't stress out. Work with experts. You do not want to be in a situation where you get a letter from the IRS because no one ever told you about UBIT. And you know what? It happens. I deal with this a couple times a month. Adam, I use company X, company Y. No one told me about UBIT. I'm so pissed off. I just now have to pay all this tax. I would never use my IRA or 401k. So that's why we want to work with you up front. That's why I want to educate everyone. Whether you choose IRA Financial or some other company, education's power. I don't want anyone doing an inefficient tax investment. The worst thing possible. Okay? So that's why I do these videos. That's why it's so important to watch them and learn. Okay? We do have an audit guarantee structure. We definitely do that. Flipping contracts, I'm not worried about. Again, I don't think you have an issue with flipping contracts. It's so passive in nature. I don't see how the IRS would ever argue your retirement accounts in a business for literally pushing paper. It's even more passive than literally buying stocks or Bitcoin. And I have clients that trade Bitcoin and stocks thousands of times a week. So don't stress about that. I'd focus on your investment more than UBIT. But UBIT could be an ugly 4-letter word that could turn a very tax-friendly investment into a tax nightmare. So work with experts, be educated, ask questions, and remember, in most cases, UBIT will not apply. 3 instances it applies. I went through the 3 instances. I'm going to say it one last time. Non-recourse loan to buy real estate, exception for 401ks. Applies to IRAs over $1,000. Invest in an active trader business through an LLC or partnership. Applies to IRAs or 401ks over $1,000 in net income. Use a non-recourse loan in an IRA or 401k to acquire an asset. If you do option trading, that does not trigger UBIT. Otherwise, thank you so much for watching. I know this was long. I hope I didn't bore you, but it's super important. And if it didn't apply to you, I hope you learned something. Also, what I would say is we have now, if you're looking to set up a self-directed IRA or 401k, check out our website. We have a new get started quick option where you can set up an account in literally like a minute. And then we'll walk you through the whole process because we want to make it easy for you to get going. And we'll customize the IRA or 401k in the best way to minimize UBIT and allow you to explore and take advantage of all available tax strategies. And we don't just stop there. We do the tax reporting, the tax filing, the admin, the record keeping, and all the consulting. So thank you so much for watching. Have a great day. And I'll see everyone next week. I'm taking a break. I'm doing some skiing with my kids. I do that once a year. And then I'll be back the week after for some solo 401k basics. So look out for that. Have a great day and see everyone again soon. Thanks.